Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Dougal Cameron of Golden Section Ventures. Dougal, thank you for joining us.
Thank you, Hall.
Great. So what was your background before starting to invest in the early stage companies? What did you do before this?
Yeah, I got started in early stage, really first from the dinner table growing up at our house. My dad introduced me early on to business and to some of the things that he was investing in and the entrepreneurs that he was backing. And I didn't really know this growing up, but after going to college and graduating and starting work at the Federal Reserve, I realized all of a sudden that I come from a long history of entrepreneurs, and working in a large bureaucracy just didn't fit me very well. And so I got started really when I think back on it early on in my life, and stories from how businesses we had invested in as a family were doing were kind of constant dinner table conversations, mainly from the personal side of how the entrepreneurs were doing, big contracts they were looking to win, things like that. So I got a lot of operational insight into a investor perspective that was pretty in the weeds and very operationally focused. I graduated in 2009 from Rhodes College with a degree in history and in math. And I worked while at Rhodes for a private equity firm that was on the small end on the enterprise value kind of spectrum. The businesses were anywhere from $15 million to $40 million businesses that were almost always, I'll call them old economy companies, nuts and bolts manufacturers, value-added distribution, service companies, things like that. They were kind of the antithesis of what I do now, which is B2B Enterprise SaaS companies. But there's a lot of similar dynamics. And so that got me very interested in the space of maybe small company management and small company operations. I got formally into software as a focus professionally in 2011 with my partner, Isaac Shi, who I own Golden Section Technology and Golden Section Ventures with. We started it in 2011 when he was on a furlough from a business that my family had co-founded with Isaac that is called Prognosis. That company was a browser-based EHR in the rural hospital healthcare space. And we had scaled that company and it sold in 2010 to a private equity firm out of Boston. And then Isaac and I, after we started Golden Section Ventures, had the opportunity to buy it back with a couple of partners, including my family, in 2013. And we fixed it up and got it growing again and sold it a year and a half ago to Kane Anderson portfolio company called Azalea Health. We've done a couple of different things over the years, but I kind of formally got into the B2B Enterprise SaaS space in 2011 and have been there ever since.
So what's your advice for people investing in the B2B SaaS space itself based on your experience?
Yeah, that's a great question. I've thought a lot about this because we've got a network we invest with. We're not a formal fund. We use our own money and then a network of friends and family. We do about $2 million worth of seed stage investing per year. And that's everything from, say, the first dollar of revenue up to about $1 million in annual recurring revenue. And that's the space we play in. So my advice is really targeted toward that sector, not only the B2B enterprise SaaS sector, but that maturity, so the seed stage investment time horizon. And so I thought through 5 things on this question. The first piece of advice is have a healthy level of skepticism. I think this is a really exciting area to invest in, and sometimes that excitement can cause some blindness on the deals. I'm really fortunate to have a pretty big team of software development engineers and technical experts around me. We have 65 people that work for Golden Section Technologies. And so we use that capability in our client, in our portfolio, and in diligencing deals. But I would say have a healthy level of skepticism and expect a pretty high degree of conversion to lifestyle business in this sector, as well as a really long time horizon, about 10 years for your investments. The second piece of advice would be to find experts to co-invest with that know the end user market, so know the buyer of the product or the service that's being produced. I think that is absolutely critical. And you need to have people outside of the management team that can give you that advice. The third thought is to apply a portfolio theory concept. A lot of the people that we invest with will have the temptation to maybe overinvest in one particular deal, which is not a great idea if you're not playing with a whole lot of money. And so, portfolio theory works pretty well in this space. You need to be diversified over a lot of different deals. With one caveat, typically portfolio theory, you keep reinvesting in the underperforming sector. You don't want to do that. In this space, you want to keep investing in the businesses that are winning because the returns are wildly asymmetric. And so it's portfolio theory with that caveat. The next piece of advice I've learned, fortunately, mostly vicariously through others. I've also learned it once or twice on my own, painfully, which is to not chase a down round. There's a lot of cognitive errors that pop up during down rounds, and down rounds happen a lot in this space, particularly if you're in very early. And so part of that is making sure you price it right on the front end. But down rounds typically dynamic where management's stressed and therefore less likely to reveal weaknesses. Most of that's unintentional, right? Investors are also chasing a sunk cost fallacy. Sometimes management is helping that with the prior point that they're less likely to reveal weakness. And then because of that instinct of the sunk cost, there's a confirmation bias that really takes you the rest of the way. So it's something to be really careful with. The last bit of advice would be to look for very invested founders that don't really have any way out but to make your deal a success. I bump into a lot of founders that are looking for someone to pay for their salary for a couple of years. I think that's a pretty bad way that's a really easy way to lose a lot of money fast. And you want founders that are absolutely completely invested in the idea, invested way more than you are as an investor in the idea succeeding. But with that advice, you also therefore have to be really careful about hindsight or confirmation bias, because with very invested founders, they're going to be overlooking risks, which is part of what makes them founders and part of what makes the idea of work. But it's also something that as an investor, and it goes back to really point number one, have a healthy level of skepticism. You've got to be able to help the investment team and the management team understand what risks are they overlooking when they're forecasting out the next couple of years, particularly in how they're going to spend that investment capital.
Well, that's great advice. The B2B Enterprise SaaS market keeps evolving and maturing and so forth. How do you see the industry evolving at this stage?
Yeah, I think that we're located in Houston, Texas. And so most of the startups we focus on are not on the coasts. They're in the heartland. They're in the sort of the middle part of the country. And so we have businesses. We have a company up in Michigan, and we have businesses all up and down from Michigan down to Houston and so forth. And so because of that, I see the non-coast B2B enterprise SaaS funding industry evolving quite a bit. I think there's a big upswell right now with a lot of local programs, governments, and institutions that are supporting a local investment ecosystem. Virtually every city is doing this, and they're putting quite a bit of money into it. I think that's ultimately going to be good, but in the immediate time period, I think it can create some problems. I think the new entrants right now are showing up with pretty big checkbooks, and they're not necessarily on the coasts. And I think that it's very likely that they're going to make some pretty bad investments, particularly if they haven't done this before or if they haven't invested in this sector over a couple of years. And as a result, I think the typical risk-calibrated investor, someone that's been in this space or is really thinking about the right price initially to get a risk-adjusted return, is likely going to be priced out of a lot of deals for the next 5 years or so, or there's going to be pressure to do deals outside of that risk spectrum. And so I think it's more important than ever right now to have more than just money that you can bring into a business. And I think that's important not only for the finding really good, high quality deals, but I think it's also important for founders to understand that dynamic and not get trapped into taking money at a really high valuation that might seem really, really good for that round in terms of its minimal dilutive impact to your ownership, your equity ownership. But it also traps you into trying to establish a business that can beat that price, or you fall into a down round scenario, which is bad for everyone. And so I think the market's pretty frothy right now. And so what I'm expecting to have happen as a result is a bit of a reversion, either from founders that get wise to that and look for strategic investors that can add more than just capital, or for investment to regulate on what it's expecting as a return.
Well, that's good advice. I've had some investors tell me that they're not worried about the company raising this round, but they look to see if they can raise the next round based on what the money they're raising, the valuation they're putting out there. So looking ahead gives some indication of where it might go. So what is your investment thesis for this sector? What do you look for in these deals in specific?
Yeah, absolutely. So our firm, we do business, we do technology consulting for B2B enterprise software businesses. We also invest in them and we provide a roadmap. We call it the roadmap to $1 million in ARR. We think that that's the place we play in the most. It's where we can add a lot of value, and we've done this several different times. And so as a result, that's kind of we target. We feel like we've got a pretty good mechanism to identify deals that are really good products, great founding teams, and big problems to solve when they're very, very small, between 1 and say 500,000 in revenue. And because of our ability to, number one, have a deal flow in that space because of what we do on the technology consulting side, and with our ability to vet and diligence the technology architecture, we feel like we can come up with a good win-win scenario for the founders that we partner with. And we add a lot more than just capital, which went back to my earlier point that I think this market, it's important to bring more than just a checkbook. And so typically what we look for are deals that are between $1 in revenue and 500,000. We look for companies that are post-product and in which the founder is substantially invested. We also look to be the first non-friend and family money into the business. And I think post a lot of non-friend and family investments, the cap table can get kind of messy, and we can help in that environment. But most of the ones that we do, we're the first capital in. We can really help lead on the budgeting and capital forecasting side of the equation, in addition to the technology. We look for the founders that we partner with to be experts in the workflow that they're looking to improve with software. And B2B Enterprise SaaS is almost always about the workflow. There's a few exceptions to that, but we look for people that know the workflow inside and out and need some strategic support on the software side, on the technology side, or on the capital side, which obviously we participate in. So I'm betting that we can pick up a high quality team that can bring ideas to reality and get to $1 million in ARR. Expectation after that $1 million in ARR level is to help the founder preserve as much of their capital as possible through unlocking non-dilutive capital sources that we have access to. And we look to leverage those non-dilutive sources either all the way through a non-institutional approach or help them make the right decision on the next institution that gets involved. We've got a couple of stories in our history, in addition to the one I told briefly about Prognosis, where we sold the business to a very large institution, and then we bought it back because it ultimately didn't do a great job with it. And so we've got, I think, a healthy level of skepticism about institutional capital, and we can help navigate those waters. We think ultimately right now, the market is expecting all deals to make it to $1 billion or bust. And we think that there's a lot of deals that die on the path from $1 to $1 billion that would have been really, really nice $200 million enterprise value companies. And perhaps that's what they needed to be, instead of stressing them with more and more capital at a higher and higher valuation that forced them into markets that they shouldn't have been in or should have taken more time to get to. And we think because of that, there's a slower path that's being overlooked. And we think that we've got the map to that path. And so that's what our investment thesis is. Do we have a founder that's super invested, that can execute against a plan, that's an expert in the workflow that they're trying to solve, and who's on board with preserving their equity and getting to a really, really nice outcome, but isn't personally invested in the idea of being a billionaire? We don't feel like that's the right fit for us culturally.
Are there any particular startups that fit that thesis that you can call out?
Yeah, absolutely. And I'll caveat this with, I think everything we invest in, obviously our expectation is to make a risk-adjusted return on our capital. We're not betting on something where we have to have in our fund, we have to have $1 billion outcome on a deal in our fund. We don't have to have that. But everything we invest in, I think, absolutely could reach that potential. So this isn't to cast any shade on any of the startups we do business with. We have a business that we incubated an entrepreneur for a year, and we just launched him out January 1st of this year. The company is called QMSC, QualityMSC.com. It's a really great business that has a marketplace potential within the workflow product that it serves. And what I mean by that is they can connect to a consumable within that workflow and derive some value from that part of the supply chain, in addition to charging for the workflow, which is something we're pretty excited about that element within B2B SaaS right now. And it's a quality management system product that serves a pretty large and growing market of regulated companies that need to maintain digital quality documents. Another business that we've invested in that we're very excited about, that we've partnered with the founder over a couple of years, is called System Surveyor. I think they've actually they did your program, and that they've gone out on the email chain. And so that's a startup we're very excited about. The founder there, his name is Chris Hugman, and he's just done a fantastic job. Both of those businesses are profit-minded when they're growing, so they're not burning cash for the sake of burning cash. They're very capital efficient, and they have incredible potential, and that's what makes us really excited about those.
So what are some of the challenges you see your entrepreneurs face after they raise funding and they start that trek up to the $1 million ARR milestone? Where do you see the initial challenges come in for them?
Yeah, that's a great question. The first challenge is over-investing in the product. And I don't mean that in the sense that you should spend less on your product. Your product is what you're selling. It's vitally important. But I mean trying to develop a custom system for all of your early customers. Every customer wants it done their way. And the big challenge of a product owner, which the founder typically is the product owner or the product manager for the first couple of years at least, is saying no strategically and saying no well to where you don't lose business, but you're also not bastardizing the product for the sake of one customer. And that's a challenge. It's a pretty big challenge. It's something we harp on a lot with our portfolio companies. And we've worked a lot with quality MSC on that exact item, because everybody has a different way that they do quality. And part of what the value we're trying to bring to the market is giving a consistent workflow to how firms manage their quality documentation. And it's a give and take on your customers and on acquiring customers. We think that's a challenge. Another challenge that's more generic is over-investing in nice companies. I've sort of hit on that a few different times, but taking more money earlier than you should can create some problems, not only for justifying the price point, like you mentioned, in trying to justify the next funding round's price, but also in deploying capital efficiently. It's easy to do urgent but not very important, expensive things when you have a lot of capital that you wouldn't otherwise do if you were a little bit more constrained. I think a problem in this space for investors is diligencing the deal and diligencing the team effectively. Mentioned similar to what I mentioned before, I think it's really tough to get through the exciting kind of sex appeal of investing in this space and look at dispassionately at the idea and at the team to ask the right questions and make sure that you know exactly who you're investing with, because it's a long road and there's a lot of ways that it can go wrong. I think the biggest way that it can go wrong, outside of whether or not you've got the right customer group and the right product to serve that customer group, this is the biggest way it can go wrong, I think, from the investment side, is getting an investor involved in your company that's not philosophically aligned with what you're trying to accomplish. Investors that aren't used to investing in this space maybe are not totally aware of what impact they're having on the founder. It's a really emotional thing to take money from somebody. And it's also emotional to invest in somebody. And that's what I mentioned earlier, interview about my first interaction to startup and early stage investment was around the dinner table with my dad talking relationally about what's going on in these businesses. And so it's a really intimate thing to have somebody invest in your business and in your idea and essentially in you. And if you have people on the cap table, one risk that I look at pretty strongly is exactly this. If you have someone on the cap table that hasn't invested in this type of instrument before or in this space, and they all of a sudden start getting nervous about their investment, maybe they overinvested or maybe their risk appetite has changed because they lost money in another deal or whatever it might be, something happens personally. If an investor starts causing trouble for the management team, it can be really damaging to all the investors. In fact, the worst example that I've gone through myself of that happening, the investors that were the cause of the problem were less than 2% of the total capital raised. So they were a tiny fraction of the cap table, but still it causes the entrepreneur an enormous amount of emotional distress, which they have no business having to entertain at that moment. They need to be focused on scaling the company. So I think that's a big risk, is who is investing with you and making sure that not only when they're diligencing you, not only that you're answering their questions, but also you turn around and diligence them as an investor. Because it's a long journey, they're not going to not interact with you. There's going to be a lot of interaction. If you don't get along in the diligencing stage, it's a pretty big red flag, and no amount of money is worth a bad investor management relationship.
So where do you see the immediate opportunities or subsectors to pursue in enterprise SaaS these days?
I think the biggest opportunity in the B2B enterprise SaaS area is that I think what's happening right now is the marketplace is dividing from large monolithic systems that handle multiple workflows into a best of breed API driven environment. Larger corporations are getting much more comfortable with things like Okta for a single sign-on platform that stitches together security over multiple systems. And what that does is it allows smaller businesses the opportunity to perfect a workflow and bring it to market where they otherwise would have been selling against a more comprehensive product suite. They don't have to do that anymore because of the advent of web service and of things like single sign-on and distributed analytics and things like that. So I think that there's a big opportunity in perfecting a workflow and being the best of breed in that area, which cuts against, and I mentioned this before, it cuts against the path to $1 billion. A lot of roadmaps to get to a successful outcome as a startup include looking for horizontal markets and scaling horizontally. That's not something that we encourage our businesses to do. We would much prefer them to own the workflow that they set out to conquer and go deep with that customer and go deep with that industry and be the look-to expert in that space long before they try to pivot to a horizontal market. And so I think that there's a lot of opportunity in looking at workflows that are secondary or tertiary offerings within large monolithic systems and being the best provider of that system in that space. I think that's a major opportunity. I think another opportunity is given that you're providing a workflow and you're providing a better way for someone to leverage human potential, which is essentially what software does. I think looking at the transactions that happened in that workflow is a really interesting way to add a lot of value to the idea of the business. So I mentioned quality management system consulting before, qualitymsc.com. That business has the opportunity to plug into the quality management system of companies all over the world. And in that system, they'll have insight into the maintenance records potentially of those customers and be able to serve those customers either renewals on maintenance equipment or maintenance service agreements or other things that are service driven outside of the product offering, which dramatically increases the total revenue opportunity and it passes an enormous savings to the customers. And so I think that things like that are a really big opportunity. And most of the startups we talk to haven't thought about that revenue opportunity inside of their business before we start brainstorming. And in virtually, I don't know that I've encountered a workflow point solution that doesn't have a dynamic like that they can take advantage of.
Well, that's great insight into this industry. In the last few minutes that we have here, what else should we cover that we haven't?
I think we covered a lot. I would just reiterate that for founders out there, I've been a founder. I've also bought a turnaround business that was Prognosis and ran it for a couple of years. I've dealt with a lot of private investment, not only as the management team, but then also as the investor. And I can't overstate enough the importance of diligencing who's going to be investing in your company. I think that is vitally important, and it's not done very frequently. In fact, I'm amazed at how little the time it's done on me, which is something I look for because I want to know that I'm invested with a management team that's going to take seriously every element within their business. And the cap table and who's on your cap table is a really serious thing. And so if you get someone that's going to be a pain in your rear and they're the last 50 grand to close your round, it's not worth it. It's even not worth it if they're going to be your majority investor. So I think just reiterating that point that if you're a founder looking for capital, be careful who invests in your business. And that's not said to try to win more deals for people that it's a big risk that's often overlooked by founders. And it's also often overlooked by investors because as an investor, you're betting in a management team. There's a lot of things that can throw that management team off their game. And one of the big ones is investor discontent. And that can happen despite the deal really doing well because it's not hitting some arbitrary metric that some investor had in their mind, or just because those investors are having a bad day, or there's some interpersonal breakdown of relationship between the management and the investor. And so that's something I would I just reiterate that you've really, as a founder, you've got to be careful of who you let invest in your deal. And that's a sensitive thing because obviously the power dynamic is the exact opposite. The investor has the power and the founder, it's a sensitive thing to bring up, but it's really important. And so it's worth thinking through how you'll handle that and then handling it with as much grace as you can.
That's great advice. So how best for the listeners to get back in touch with you?
I think LinkedIn is a great way to get in touch with me. You can also reach me on our website, gstdev.com. And in addition, I'm on Twitter, and that's at Dougal Cameron, all one word.
We'll add those to the show notes. Appreciate your taking time to share that with us today and look forward to having you back for a follow-up soon.
Absolutely. Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.